Looking to invest in real estate, but you aren't sure where to invest? By the end of this video, you'll learn all the different factors that real estate professionals consider when deciding where to invest in real estate. Location, location, location. If you know anything about real estate, you've probably heard this mantra before. And it's true. The location of a property can be the difference between fat profits and losing all your money. In this video, we're going to show you exactly how we determine where to invest. And I'll also share with you our very own list of locations that we love to invest in, so make sure to watch until the end to get all the details. The best part? You can invest in real estate in any location and invest remotely from the comfort of your own home. Make sure to watch this video until the end to learn how to do this. When looking for a location to invest in real estate, it's essential to consider the local economy's growth. As the economy grows, it typically results in increased job opportunities, higher wages, and a stronger consumer base. This can lead to an increase in demand for real estate assets, such as residential and commercial properties, as more people are able to afford to buy or rent properties. In turn, the increased demand can lead to higher rental rates, property values, and potential returns for real estate investors. On the other hand, economic downturns can lead to a decrease in demand for real estate assets, as people may have less disposable income and businesses may be less likely to expand or invest in new properties. This can result in lower rental rates, property values, and potential returns for real estate investors. Real estate investors can use economic growth as an indicator of the potential health of the real estate market and the potential returns on their investments. By analyzing economic indicators such as GDP growth, unemployment rates, and consumer spending, real estate investors can make a more informed decision about when and where to invest in real estate assets. For example, if an investor sees that a particular region is experiencing strong economic growth and job creation, it may indicate that demand for real estate assets in that area is likely to increase, making it a more potentially profitable investment opportunity. Population growth is another important factor to consider when selecting a location for real estate investments. As the population grows, it typically results in increased demand for housing and other real estate assets such as retail and commercial properties. All this can lead to an increase in property values, rental rates, and potential returns for investors. Additionally, population growth can influence the type of real estate assets that are in demand. For example, as the population ages, there may be an increased demand for senior living communities or healthcare facilities. Or as the workforce becomes more mobile, there may be an increased demand for rental properties near public transportation or job centers. Real estate investors can use population growth as an indicator of the potential demand for and value of real estate assets, helping them make more informed investment decisions. By analyzing population trends and demographics, investors can identify potential investment opportunities and adjust their investment strategy accordingly. Market strength refers to the overall health of the local real estate market. Strong markets typically have low vacancy rates, high demand, and increasing property values. Market strength is sort of a macro view of the previously mentioned factors. Various economic indicators such as job growth, income levels, consumer confidence, and supply and demand trends speak to the strength of any given market. When these indicators are positive, it can tell an investor all they need to know. For example, if an investor sees that the real estate market in a particular region is experiencing high demand, low vacancy rates, and increasing property values, it may indicate that it's a good time to invest in real estate in that particular area. Conversely, if the market is weak with low demand, high vacancy rates, and decreasing property values, it may be a sign that it's not a good time to invest. By analyzing market strength indicators, real estate investors can make more informed decisions about where and when to invest in real estate. They can adjust their investment strategies to take advantage of strong markets and avoid areas with weak markets. This can help investors maximize their potential returns while minimizing their risk. A little economics 101 can help us think about this next indicator. The principle of supply and demand states that when demand for a particular good or service is high and the supply is limited, the price of that good or service tends to increase. Conversely, when demand is low and supply is high, the price tends to decrease. This principle applies to real estate as well. In real estate, when there is high demand for properties and limited supply, it can lead to increased property values and rental rates. On the flip side, when there is a low demand and high supply, it can lead to decreased property values and rental rates. Investors can use supply and demand as an indicator of potential investment opportunities. By analyzing the current and projected supply and demand trends in a particular market or region, investors can identify areas where demand is likely to be strong and supply is limited. Additionally, analyzing supply and demand can help investors determine the optimal timing for buying or selling real estate assets. For example, if an investor sees that the supply is increasing rapidly in a particular area, it may be an indicator that it's not the best time to invest, as it may lead to lower property values and rental rates. Understanding the local regulatory environment is essential for real estate investors. Local regulations and policies can affect real estate investments in several ways. For example, zoning laws can determine what types of properties can be built in a particular area, which can affect the supply and demand of real estate assets. Building codes and permitting requirements can affect the cost of construction and renovation, which in turn can impact the potential returns on an investment. Environmental regulations can impact the value of properties, particularly those that are located in areas with environmental concerns or restrictions. Additionally, local tax policies can impact the value and profitability of real estate investments. Property taxes, transfer taxes, and other fees can vary significantly between different regions and municipalities, and then can affect the overall cost of ownership and potential returns of an investment. By analyzing local regulations and policies, investors can identify potential roadblocks or challenges that could impact the value or profitability of their investments. They can also identify areas where favorable regulations and policies could provide opportunities for increased returns. By analyzing local regulations and policies, investors can adjust their investment strategies accordingly. Affordability refers to the ability of potential buyers or renters to afford the price of real estate assets. When affordability is high, it can lead to increased demand for properties and potentially higher rental rates or property values. Conversely, when affordability is low, it can lead to decreased demand and potentially lower rental rates or property values. Investors can use affordability also as an indicator of potential investment opportunities. By analyzing the current and projected affordability trends in a particular market or region, investors can identify areas where demand for affordable housing is likely to be high. This can indicate a potentially profitable investment opportunity with the potential for increased rental rates and returns on investment. Additionally, analyzing affordability can help investors determine the optimal pricing strategy for their real estate assets. For example, if an investor sees that affordability is low in a particular area, it may be an indicator that it's not the best time to raise rental rates or sell properties at a high price. Conversely, if affordability is high, it may be a good time to consider increasing rates or selling properties at a higher price point. Safety is a top concern for many renters and homeowners. Crime is a very useful market indicator for real estate investors because it can have a significant impact on the value and desirability of a real estate asset. Areas with high crime rates may be perceived as unsafe and undesirable by potential buyers or renters, which can lead to decreased demand and lower property values. For more tips on real estate investing, make sure to hit the subscribe button. Downtown areas in cities like Phoenix and Milwaukee are attractive markets for investors because they often feature a vibrant mix of commercial and residential properties. This leads to a high demand for housing from professionals working in the area and a diverse pool of potential tenants. Additionally, the ongoing revitalization and development projects in these cities contribute to the appreciation of property values. The Sunbelt states, such as Georgia and Alabama, are appealing to real estate investors due to their warm climate, relatively low cost of living, and growing job markets. These factors attract new residents, leading to population growth and increased demand for housing. In addition, these states typically have landlord-friendly regulations, which can make it easier for investors to manage their properties and maximize their returns. Landlord-friendly states like Texas, Indiana, and Florida are all desirable for real estate investors because they have laws and regulations that favor property owners. This can include faster eviction processes, fewer restrictions on rent increases, and lower property taxes. These benefits can make it easier for investors to manage their properties, minimize risks, and optimize returns. Remote investing can be an attractive option for investors who want to diversify their portfolios and take advantage of opportunities in different markets. Investing in turnkey real estate, syndications, and funds allow investors to participate in these markets without the need for direct property management. Turnkey properties are fully renovated and managed by a property management company, while syndications and funds pool together investor capital to acquire and manage larger properties. This allows investors to benefit from the cash flow and appreciation of properties in various locations, even if they don't live nearby. We've got a free gift for you in the description of this video. Look, we're here to help you with any and all of your passive investing needs. But it's no secret that our favorite asset classes are mobile home parks and parking facilities. It's what we do every single day, and we know it like the back of our hands. If you want to learn more about what, in my humble opinion, is one of the best asset classes in real estate, click the link in the description to download our guide to mobile home parks. Thanks for watching, and I'll see you on the next video.